The final thing we're going to learn in this chapter is to prepare and evaluate a flexible budget. And we're going to use performance reports to evaluate a flexible budget. Let's first take a look at what is a flexible budget. A flexible budget is a budget that we prepare for a different level of volume than which it was originally anticipated. The variance that you learned how to calculate before when you were calculating your responsibility center performance reports, we're actually going to call that the master budget variance. The master budget variance is the difference between the actual revenues and expenses and the master budget. Let's take a look at another example. They've given us the cost information up here. They've told us that the sales revenue per unit is $15 per unit. They've told us variable cost per unit is $10 per unit, and the fixed expenses are $80,000. They've also given you the master budget, the budgeted amounts, and the actual amounts right here. So let's calculate our variances. Remember, we're going to call this the master budget variance. That's the difference between your budget and actual. Sales units were 25,000 for the budgeted, actual were 28,000. We have a variance of 3,000 units. That variance is that favorable or unfavorable. Again, this is a unit, and I'm just showing you that so you understand our calculations that will happen later on. But that 3,000 units is really a favorable variance. You sold more, 3,000 more than unfavorable. Now let's do the real variances for our dollar amounts. Our sales is 375,000 for budgeted. Actual sales are 400,000. So our variance is 25,000. Now we need to figure out whether that 25,000 is favorable or unfavorable. We expected sales of 375,000. We actually made 400,000, which is better because these are sales. So it's a favorable variance. Next, let's look at variable expenses. Our budget was 250, actual was 260, so our variance is 10,000. Remember, you do not put negative amounts, you just put the number, and your negative is taken into account by saying whether it's a favorable or an unfavorable variance. So in this particular case, we came in over than what we expected, and this is an expense, so it is an unfavorable variance. Let's take a look at fixed expenses. We expected it to be 80,000. Actually, we had 85,000. So we had 5,000 over, which means it's an unfavorable variance. For our operating income, we expected to have $45,000 in operating income, but we actually ended up having 55,000, which is more, and since it's profit, that is better for us. That is a favorable variance. So we look pretty good. We had a favorable variance in sales. We did come out unfavorable on variable expenses and fixed expenses. However, we came up $10,000 in profit more than we budgeted for. So this is great. However, this is not really a good comparison because our master budget was for 25,000 units and our sales units were 28,000. Our actual sales units were 28,000. So we're really not comparing apples to apples. We're kind of comparing apples to oranges. To get a better picture of how we really performed, we should prepare a budget for 28,000, which is our actual volume of units sold. We call this budget a flexible budget. So we have our master budget, which we prepared for 25,000 units in sales. Now we're flexing it to reflect actual sales. Actual sales were 28,000, so we're preparing a flexible budget to reflect actual sales so we can compare whether our actual numbers compared with a flexible budget. So let's go ahead and prepare a flexible budget. To prepare a flexible budget, you've got to calculate what should have been your budgeted sales at 28,000. They've given you that the sales price is $15 per unit, so you can say that your budgeted sales is 420,000, 28,000 times 15. Your variable expenses were $10 a unit, so you can calculate your variable expenses to be 28,000 times $10 or 280,000. Your fixed expenses were budgeted to be 80,000. You know that with changes in volume within your relevant range, your fixed expenses remain constant. So your fixed expenses are going to be 80,000 as well. That gives you an operating income of $60,000. The $60,000 is $420,000 in sales minus 280 plus 8 in variable expenses minus 80,000 in fixed expenses, giving you $60,000 in operating income. Now you can calculate your variances against your flexible budget to see how you came up with your actual numbers. Your actual sales were 400,000, whereas your flexible budget said that we should have gotten 420,000. So you had a 20,000 unfavorable variance. I'm going to put the unfavorable on this side. You've got a 20,000 unfavorable variance. Let's look at our variable expenses. We expect our variable expenses to be 280,000, but they were actually 260,000. So this time we also had a 20,000 variance, but this time, since it's an expense, it is a favorable variance. We had 80,000 expected in our flexible budget for fixed expenses. We came in at 85,000, which means we had a 5,000 variance, and that 5,000 variance was unfavorable. Looking at our operating income was expected to be 60,000, but we came in at 55,000, so we had a 5,000 variance in operating income, and the variance is unfavorable because it's less than what we expected. The variances that we calculated are called flexible budget variance. So those numbers that we calculated are called the flexible budget variance, and the flexible budget variance is the difference between your flexible budget and your actual numbers. Now there is another set of variances that we need to calculate, and these variances are the difference between your master budget and your flexible budget. Let's go ahead and do that next. I've added a column so we can put whether our variance is favorable or unfavorable. So for the master budget, we expected 375,000, and our flexible budget was 420,000, a difference of 45,000. Is this 45,000 favorable or unfavorable? It's revenues. We expected 375. We should be getting 420, so that is a favorable. Whenever you're doing variances, you're always going to look at your rightmost column and then compare that to your column on your left-hand side. Next, let's look at variable expenses. You expected 250,000. Your flexible budget says 280, so that is going to be a $30,000 unfavorable variance. For your fixed expenses, your flexible budget and your master budget have the same number, so your variance is 0. Whenever you put a 0, you do not need to put unfavorable or favorable. I know my Excel makes it a dash, but you should put a 0 there when you're filling in your worksheets. For operating income, for your master budget, you're expecting 45. Flexible budget says 60. That's a 15,000. And since it's an operating income, it is going to be a favorable. If you notice, when you go down the column of your variances, they do add up, but you have to keep in mind, you need to keep in mind whether they're favorable or unfavorable. So 45,000 favorable plus a 30,000 unfavorable is equal to 15,000 favorable variances. It's kind of like the unfavorable variances are subtracted from your favorable variances. But the best way still is to look across from one budget to the next to help you calculate whether it's a favorable or an unfavorable variance. The variances that we just calculated are called volume variance. The difference between your master budget and your flexible budget, the variances are called volume variance. Again, to summarize, your volume variance is the difference between your master budget and the flexible budget, and this arises only because the actual volumes differ from the volumes that we originally anticipated in the master budget. The flexible budget variance is again the difference between your flexible budget and your actual results. When you're looking at it visually, on the right hand corner you would have your master budget. In the middle you would put your flexible budget flexed for the actual level of sales volume, and on the leftmost side you will have your actual results. The difference between your master and your flex is your volume variance, and the difference between your flex and actual is your flexible budget variance. The sum of your flexible budget variance plus your volume variance is the master budget variance. Another way to look at it is the master budget variance is the difference between your master budget, which is on your rightmost corner, and your actual, which is on your leftmost corner. Finally, whenever you're investigating the underlying causes of the variances, you need to keep in mind that you're going to use management by exception. Management by exception means you're going to look at variances above a certain threshold, and you are going to investigate favorable as well as unfavorable variances.